Hello and welcome to the new series of Drishti IAS. I am Pooja Divedi, and in this segment today, we are going to talk about the monetary policy of India. This topic is important from the perspective of prelims and also from the perspective of GS Mains Paper 3. So let's begin with the topics of discussion that we are going to look at. First of all, we will talk about why news. Then we will talk about the highlights of the meeting that has recently been convened from 3rd of February to 5th February. We will talk about the monetary policy. What is the monetary policy? We will focus on repo rate and reverse repo rate, the key instruments of monetary policy. We will also talk about inflation, the challenges related to having a proper monetary policy, the way forward, and in the last of the segment, I am going to give you a means-based question for answer writing practice. And in the midst of the segment, I am going to ask you a pre-based question. Kindly comment the correct answer in the comments segment. So let's begin. But before we begin, I would like to make you aware with a course that is available at Drishti IAS. That is the pen drive course, which offers you a holistic preparation of both prelims as well as mains. So if you want to know more about it, you can contact on the given number. Alright. So let's begin with our particular segment. Alright. So the segment has begun. And in this, it has said that the Monetary Policy Committee met from 3rd of February to 5th February in order to formulate a monetary policy that has taken into consideration the macroeconomic activities happening not only in India but around the globe. The RBI governor has said that India is on to the correct path to economic improvement, and he has based it on certain indicators. The first indicator being the mass vaccination drive. The second indicator, the second one being that the contact intensive industries, which actually have lots of contact and no social distancing norms could be available there. Those sectors have improved because of the lowering down of cases and infections. So that is the first. Second is that the consumer sentiment is upbeat and the market is upbeat. The movement of people as well as commodities is on the rise. And of course, the harvest of crops is bumper. So that is what the RBI governor has said. Now, if we look at the highlights of this report, the meeting report, what has actually been done. So, in last particular 4 times, the Monetary Policy Committee has kept the repo rates unchanged. So, if we talk about the time of May of 2020, in that particular month, the repo rate was cut down to a historic low in order to boost growth. So, kindly note down the highlights of the report or take a screenshot. I'm moving away. The repo rate stood unchanged at 4% as inflation has eased below tolerance level of 6%. So, because our Monetary Policy Committee always strikes to have the inflation rate within the range of 2% to 6%. So, inflation has eased since December. And the reverse repo rate also stayed unchanged at 3.35%. The policy maintained accommodative stance and the GDP growth pegged at 10.5% in 2021-22. So, if we talk about the repo rate and the reverse repo rate and reverse repo rate, we will talk about that further later in this segment only. And if we talk about being the stance, what is the stance basically here? It's accommodative. The Monetary Policy Committee is watching how the market is going to react, and then only it is going to change its moves. Alright. And if we talk about the GDP growth, the National Statistical Office had pegged the growth very close to whatever the Monetary Policy Committee has pegged it to, that is 10.5% in these years. So if we talk about what are the other highlights of the report, the Monetary Policy Committee has said that they will go on with the cash reserve ratio in 2 phases. The first phase will be in March and the second phase will be in May. So for the first phase, it will be pegged at 3%. Beg your pardon. 3.5% in the month of March 2021, and for May it will be 4%. And an integrated ombudsman scheme has also been introduced under this in this particular report. Alright, so moving on, let's talk about what is basically monetary policy. Now, monetary policy is a policy that actually watches over the macroeconomic developments in an economy and accordingly uses different monetary instruments in order to provide growth, stability and economic stimulation in a country. That is the entire gist of monetary policy. But for your more understanding, kindly note it down. Monetary policy refers to the policy of the central bank, that is the Reserve Bank of India, in the matter of interest rates, money supply and availability of credit. So these are the three basic necessities in a monetary policy. First will be interest rates. Through that only the different banks under the Reserve Bank of India can lend credit, lend loan or take loans, and of course according to that money supply will get reinvigorated in an economy, and then only the RBI will see that there is an availability of credit or not. What is going to be the liquidity status in an economy? And monetary instruments are like repo rate, reverse repo rate, SLR, CRR. There are different instruments which are needed to achieve this purpose. And if we talk about under which act the RBI is empowered to formulate monetary policy, it would be the RBI Act of 1934. And if we talk about the types of monetary policy, there are two types: expansionary monetary policy and contractionary monetary policy. In very simple terms, in expansionary monetary policy, the RBI, the central bank of any country, seeks to expand the money supply, and that is why it will try to reduce the repo rate. Once the repo rate gets reduced, the banks will get more and more loans because the rate will be less, the more loan would be taken by the other banks, and then liquidity will be introduced in the economy. Why? Because banks have availability of loans from RBI, then the customers will also have availability of loans from the different banks. And contractionary monetary policy is basically, it strives to achieve less and less liquidity in the market. The RBI will increase the repo rate. Once there will be an increment in the repo rate, the different banks will be borrowing less, and hence they will not be able to pass on the benefits of loan to the customers, and hence the liquidity will decrease. So that are the types of monetary policy. So if we talk about the Monetary Policy Committee, let's note down few facts about it. Monetary Policy Committee is a 6-member committee. It is constituted by the central government, and this is the section, this could be asked in your prelims exam, Section 45ZB of the amended RBI Act 1934. And this committee should meet at least 4 times a year. The resolution adopted by MPC is published after the conclusion of every meeting of the MPC. Once in every 6 months, the RBI is required to publish a document by the name of the Monetary Policy Report to explain what are the sources of inflation and the forecast of inflation for 6 to 18 months ahead. An instrument under it used are marginal standing facility, repo rate, reverse repo rate, and liquidity adjustment facility. There are also other instruments such as cash reserve ratio and statutory liquidity ratio. Now, if you want to know more about it, you can read it on our website. But once we are discussing repo rate and reverse repo rate, we will also discuss about CRR and SLR. Okay. Moving on, let's talk about the comparison of repo rate and reverse repo rate. Okay. So here repo rate says, repo rate is the rate at which Central Bank of India grants loans to the commercial banks for a short period against government securities. Now, repo rate in very simple terms, suppose I am the RBI and you, my dear viewers, are this different banks. So what I will do, I will give you loans at the repo rate against any government security that you give to me. So if the repo rate is very low, more and more commercial banks will come to me, more and more of you will come to me and ask for loan, and I will provide you loan, and you will easily be able to take it. Why? Because you have proper government securities as a collateral, and I am giving you all the loan at a very attractive interest rate. And reverse repo rate is the rate at which the RBI takes the loan from different commercial banks. So now I am the RBI here, and I will take loan. I will look out for loan from the viewers. All right. And if we talk about the purpose of repo rate is to fulfill the deficiency of funds. Of course, we have already talked about it that the rate is less, the more will be the loan, and the more will be the cash supply in the economy. That means it will fulfill the deficiency of funds. And also here, if we talk about reverse repo rate, its purpose is to ensure liquidity in the economy. And if we talk about rate, if the rate of repo rate is high, then of course reverse repo rate will be comparatively less. And repo rate controls inflation, but reverse repo rate controls the money supply in the economy. All right. And if we talk about how does it control the money supply, if I as RBI, I am going to take more and more loan from the commercial banks, what will happen? I will suck the liquidity out of the market because I have gathered all the money supply with myself, and there will be less cash in the economy. To control inflation, this could be also there. And it is charged on, if we talk about repo rate, it is charged on repurchase agreement, and reverse repo rate is charged on reverse repurchase agreement. All right. So if we want to move further, we should first know about a very good news, that is Drishti IAS is beginning and commencing with its offline batch in the Jaipur city. So the admissions have begun from today. If you want to know more about it, you can call on the number that is given on the Drishti IAS website. All right. So if we want to talk about CRR and SLR, now cash reserve ratio means that it properly means that a certain amount of money, a certain amount of cash, it should be maintained with the Reserve Bank of India by different commercial banks, and that is a certain percentage of the net demand and time liabilities. And if we talk about SLR, statutory liquidity ratio, this is a percentage of the net demand and time liabilities that is needed to be secured or reserved by the commercial banks themselves. This could be in the form of cash, gold, or government securities. All right. And if we want to know more about inflation, let's go through it one by one. What is inflation? First of all, we need to understand why inflation needs to be controlled. A little bit of inflation is needed in order to have proper simulation in the economy, have an incentive for manufacturers to produce so that they can earn profit. So kindly note it down. Inflation refers to the rise in the prices of most goods and services of daily or common use, such as food, clothing, housing, recreation, transport, consumer staples, etc. Inflation measures the average price change in the basket of commodities and service over a period of time. And if we want to know what is the actual opposite of inflation, that is deflation. And here comes your prelims based question, is who was the person who actually used the term inflation and in which year? Kindly tell me in the comment segment. All right. And in India, if we talk about the Ministry of Statistics and Program Implementation, this measures inflation. In India, inflation is primarily measured by two main indices, that is wholesale price index and consumer price index, which measures wholesale. That means WPI measures wholesale and retail level price changes respectively. Now WPI actually goes from the manufacturer's point of view and CPI goes from the consumer's point of view. The CPI calculates the difference in the prices of commodities and services such as food, medical care, education, electronics, etc., which Indian consumers buy for use. The RBI had earlier pursued a multiple indicators approach where it has to play the role of controlling inflation, regulating commercial banks and managing balance of payment. However, with the adoption of modern monetary policy framework 2016 and 17, inflation targeting was set as the sole objective of monetary policy of RBI. Now, what does the monetary policy of RBI actually focuses on? It focuses on controlling the inflation within the bracket of 2% to 6%, ideally 4%, right? And if we talk about what are the challenges, how to actually formulate a monetary policy is very tough, because having just one indicator, having just one particular aspect of the economy to focus on, that is the first challenge. Secondly, inflexible cost of funds. If we talk about the challenges, the first challenge here is the inflexible cost of funds. Why? Because in India, most of the funds that are available with the banks are in the form of customer deposits, and very less is borrowed from the issuance of debentures or commercial papers. Now, what about that? Because of that only, they are unable to create liquidity in the market, because the funds that have been deposited are contracted on fixed terms, right? The second challenge is that the policy rates are not linked to the market. And because of the policy rate not being linked to the market sentiment, the consumer sentiment from the markets are unable to be gauged. And that is why the Monetary Policy Committee cannot have a full-fledged overview. And high non-performing assets, because of the recurring non-debt service, the servicing of the debts are recurring in nature. So that is the problem, that once a loan has been raised, the debt is not being serviced properly. Now the problem in the balance sheet of the banks, because of that, will move on to the infrastructure balance sheet, that will move on to the real estate balance sheet, and that will further move on to the NBFC's balance sheet. Now the twin balance sheet problem becomes a four balance sheet problem. Monetary policy versus fiscal policy. Now, how to balance these two? Monetary policy is the policy that has been framed by the RBI, the central bank, and the fiscal policy is being framed by the government. Now, how to make both of them work in tandem and not against each other? Because if the friction is there between the monetary policy and the fiscal policy, what will happen? Proper gauging of the economy, having sweeping changes in the economy is not possible. Alright, and if we talk about the way forward is that we need to actually move our focus when it comes to monetary policy making. We need to move on our focus from inflation. Not only inflation should be focused on, but different other parameters should also be taken into account in order to have a full-fledged picture, because Indian economy is so diverse in nature. And linking cost of funds with market will help for that. Why? Because in order to make the cost of funds flexible, both deposit and lending rates are linked to the external benchmarks like the Mumbai Interbank Offer Rate. Coordination, of course, is very much needed between fiscal policy and monetary policy. Because if the fiscal policy is not going to work in parallel with monetary policy, the economy will at the receiving end of any negative impacts. There is a difference between the both policies. Like if we talk about monetary policy, the tool is interest rate. Fiscal policy, there is tax and government spending. Affects the cost of borrowing and mortgages under monetary policy, and budget deficit is the effect of fiscal policy. If we talk about the distribution, higher interest rates hit homeowners but benefits savers. and fiscal policy depends which taxes you raise. So there are so many differences. You can take a screenshot or note it down. Let's move on to our means-based question. India needs to move beyond the inflation targeting in its monetary policy. You have to discuss it in 250 words. Alright. And you have to keep in mind while writing this exam with respect to COVID-19 pandemic after the economy has started to get back on track. Alright. So I hope you found this segment informative. That's it for today. Tomorrow we shall meet again with another segment. Until then, stay updated and thank you so much for watching, dear viewers.